Hi, this is Akmir with a major markets review. It is Sunday, the 30th of January, starting off with the FTSE 100. And I suppose the scenario that we were looking for before this market, well, actually the better scenario, was that this market on a dip back from 7,600 would just hit the area of the 50-day moving average and then rebound has happened. So that is a plus, I suppose, for bulls. Current situation, though, is that even though we bounced off that late November uptrend line at I suppose around 7,300. We really don't want to see that broken now, so that is probably the most material technical view at the moment, that that line of support remains intact, as well as the 50-day moving average. That's around 73.60. So I suppose all in all, above the 50-day line, we're still looking bullish and get up to as high as 7,800. But we really don't want to see the mid 73s broken, and especially that line there. Wherever that happens to be when, if it is broken over the near term. Break of the 73.50 area could lead the market back down to 7,100, which is the uptrend line from the beginning of last year. And at least while we're at or above that level, one could say the uptrend from last year is still intact, but we don't want to see that level broken anytime soon, whether it's through Ukraine or any other factors. Onto the German market, which is rather more in the front line of the Ukraine situation. Here you can see that it was just a simple test of the support area that we had. So I suppose the late November rather support area around 15,000. Double tested that since. It had a little bear trap below 15,000 earlier in the month, and sort of in no man's land at the moment. Probably the easiest thing to do now is to say either we're looking to buy dips towards 15,000 or waiting for a break of that resistance line there from the beginning of January around 15,500. So end of day close above that would suggest that we're out of the woods and could head back up to the highs. Otherwise, 15,000 is the zone, and obviously we don't really want to think about what would happen if there was sustained price action back below 15,000 on this market. What is interesting, I suppose, at the moment is also the way that the 200-day moving average is flat, but the 50-day line is falling. There could be a risk of a dead cross coming through where both are falling as they cross, and that would be a signal or a suggestion that this market is about to roll over. And as I said, we don't really want to see that happen anytime soon. On to the US markets, and here we have the Dow, and I suppose it's done a slight copy of what the DAX has done. The equivalent neckline there around 34,000, so we've managed to bounce off that. We really want to see this market break back above the 200-day moving average at 35,000, which at the moment seems to be rather a long way away. There's a line of resistance also to break from the highs of this month. That's around 35,200, but I think really the 200-day line, the line in the sand. And as far as the downside is concerned, down to 33,000 we can probably handle it, as the market is would be very oversold, probably the most oversold for more than a year. But anything below 33,000 would make this look like we're at a major top, and not a good look at all. On to the S&P, which I looked at I think a couple of weeks ago in the last sweep of the major markets. Here we've also got a situation where the 200-day line, 44.40, is the block on any potential rebound. Good to see, I suppose, that there's been a bounce off the very oversold areas for this market towards 26 on the RSI scale. But we really need to break 43.44 and that January resistance line to turn this market around. If we do break above the 200-day line, the initial target here would be around the 50-day moving average level, 46.30, but at the moment that does, I have to say, appear to be somewhat difficult to imagine in the near term. In terms of support, if you want to catch a falling knife, 41.70, and that July support line projection is the favored area if there's a rug pull over the near term. But below 41.70, I would say that then we do have the risk of a major top being in place for the S&P. Moving on to the Nasdaq, which I managed to forget about last time due to advancing age, but here it is, broadening triangle here. We're right on the floor of the broadening triangle, which is actually, I suppose, a plus point, so 13,400. Want to see an end of day close back above the near-term resistance at 14,020. If we can get that, then there is a chance of a move towards the 200-day moving average at 14,750. But as you can see, this market is relatively much lower than the S&P and the Dow compared to its 200-day line. So there is a message on the state of US tech stocks at the moment. The plus point, I think, in some ways, though, is the way that the RSI went down to 23 on the latest hit, which is the most oversold it's been for over a year. So there could be some kind of dead cat bounce, let's say, back towards the 200-day line, even if we have hit a major top for US tech stocks. Jumping on to the commodities now, because the FX seems to be completely boring at the moment for some reason. But here we've got the gold market, which I think has been incredibly disappointing, given that we're supposed to be having rampant inflation coming through. That line of resistance there from the beginning of June at 1855 has snuffed out the recent recovery attempt by this market. We've got the 50 and 200-day moving averages both falling. That suggests that there could be a decline back down to the floor of the converging triangle from last March at 1744, even if we're going to then rally through 1850 plus for an inflationary boom for gold. But has to be said, gold as an inflation hedge seems to be not very useful at the moment. In fact, one could say actually crude oil is a better inflation hedge. Here we've got a situation where you can see that still stretching towards the top of this broadening triangle, which has been in place since January last year. So the top of that triangle currently pointing towards $93, and above the recent swing low for this market at 81. That could be the destination for crude oil by the end of next month, something like that. But it has to be said, looking a little bit tired now, a bit of bearish divergence coming in there as well. So maybe the first move here may be towards the downside, maybe the upper 80s, something like that, even if we then go on to conquer the psychological $100 level. Finishing off with Bitcoin, which has been, I suppose, kicked and punched quite painfully so far this year. Here we can see that after getting to the most oversold it's been for over a year, but RSI but also reflecting the same kind of RSI that we saw back in the Nasdaq, 22, 23 out of 100. Nice bear trap just below that uptrend line from last year, which was at 34,000. So we went down to 33. The easiest strategy here, though, I suppose, is to wait for any break of that November resistance line. That's around 39,000. If we can break that, then there's a chance of a fresh move towards the 50-day line at 44,000. But it has to be said, at the moment, not really looking as though this market is very keen on even breaking that line of resistance from back in November. So 39 to 40,000 looks to be the cap on this market. A break back below recent support at 33,000 would obviously would not be a good look. But you can see how this is almost mirroring what we're seeing, as I said, on the some of the indices and also on the Nasdaq. So it seems to be a new economy malaise at the moment for the markets. That's it from me today. More updates in a week or so.